Let me be direct with you because I do not have patience for the nonsense that dominates most financial advice. I have spent over 40 years in banking and finance. I have run one of the largest financial institutions in the world. I have seen the inside of how Wall Street actually operates. And I am going to tell you something that most people in my industry would never admit publicly. The vast majority of investment products that get sold to ordinary Americans are garbage. Complete and utter garbage designed to extract fees from hardworking people while delivering mediocre results. I watch it happen every single day. Financial advisors putting clients into expensive, actively managed funds that underperform simple benchmarks. Brokers pushing complex products that generate fat commissions while adding no value. Hedge funds charging 2 and 20 for returns that do not justify the cost. The entire machinery of Wall Street is optimized to transfer wealth from your pocket to theirs, and most people do not even realize it is happening. I have sat in meetings where product teams discuss how to structure investment vehicles. The primary consideration is almost never what is best for the client. The primary consideration is how much revenue the product will generate, how it can be marketed, what fees can be justified. The client's interests are secondary at best. This is not because the people involved are evil. It is because the incentive structures of the financial industry reward fee extraction, not client outcomes. When I look at the wealth management industry from my vantage point, I see an enormous apparatus dedicated to making simple things complicated. Complexity serves the industry. It justifies fees. It creates confusion that prevents clients from realizing they are being overcharged for underperformance. It generates activity that generates commissions. The simplest investments, the ones that actually work best for most people, generate almost no revenue for Wall Street. So Wall Street does not sell them. Today, I am going to cut through all of that noise and tell you exactly what I would do if I were building a portfolio for long-term growth. I am going to share the 3 Vanguard ETFs that should form the foundation of virtually any investment strategy. These are not exotic products. They are not complicated. They will not make for exciting cocktail party conversation, but they will build wealth over decades while the people chasing hot stocks and paying excessive fees fall further and further behind. Before I get into the specific funds, let me explain why I feel so strongly about this. In my position, I see data that most people never see. I see how much money flows through our wealth management divisions. I see the returns that different client segments earn. I see the fees that get charged and where that money goes. And the patterns are depressingly consistent. The clients who earn the best returns over long periods are not the ones with the fanciest strategies or the most active trading. Then the ones who buy simple, low-cost funds, contribute regularly, and leave their money alone for decades. The clients who earn the worst returns are the ones who chase performance, trade frequently, pay high fees, and make emotional decisions during market volatility. This pattern holds across every demographic, every wealth level, every time period we have analyzed. I remember a conversation I had years ago with a senior wealth advisor at our firm. He was frustrated because his best clients, the ones who generated the most fees, were actually his worst performing clients. They traded constantly. They demanded access to exclusive investments. They wanted complexity. And all of that activity generated commissions while destroying returns. Meanwhile, his boring clients who just bought index funds and ignored market noise were quietly getting rich. That conversation stuck with me because it illustrated something important about human nature and the investment industry. People confuse activity with progress. They think that more effort, more analysis, more trading must lead to better results. The investment industry exploits this misconception because activity generates fees. Every trade, every new product, Every portfolio restructuring creates an opportunity for someone to extract money from your account. But in investing, less is usually more. The data is overwhelming on this point. Simple beats complex, cheap beats expensive, passive beats active, patient beats frantic. And yet most people do the opposite because it feels wrong to do nothing, because the industry constantly tells them they need to do something, because their friends are talking about exciting investments they should not miss. Let me tell you about the 3 Vanguard ETFs that I believe should form the core of most investment portfolios. These funds are boring by design. They will not make headlines. They will not generate exciting stories. But they will compound your wealth year after year while you focus on living your life instead of obsessing over markets. The first ETF is VU, the Vanguard S&P 500 ETF. This fund tracks the 500 largest publicly traded companies in America, weighted by market capitalization. When you buy one share of VU, you are buying a slice of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, JP Morgan, Johnson & Johnson, and 493 other companies that represent the backbone of the American economy. The expense ratio on VU is 0.03%. I want you to understand how extraordinary that is. For every $100,000 you invest, you pay $30 per year in fees. $30. Compare that to the typical actively managed mutual fund that charges 1% or more. That would be $1,000 per year on the same investment. Over a 30-year career of saving and investing, that difference compounds into hundreds of thousands of dollars that either stays in your account or goes to fund managers. I have done the math countless times for people who do not believe the fee difference matters. Let me walk you through a specific example that illustrates why this is so important. Assume you invest $500 per month starting at age 30. You earn 8% annually before fees, which is conservative given historical returns. You retire at 65. With a 0.03% expense ratio, you would have approximately $1,100,000. With a 1% expense ratio, earning the same gross return, you would have approximately $870,000. The fee difference costs you over $230,000 on a relatively modest investment program. Now scale that up. If you are investing $2,000 per month, the difference becomes over $900,000. If you have a longer time horizon or higher returns, the differences become even more dramatic. Fees are the silent killer of investment returns, and most people drastically underestimate their impact because the percentages sound small. The historical performance of the S&P 500 speaks for itself. Over the past century, American stocks have returned roughly 10% annually, including dividends, some decades more, some decades less, but the long-term trend has been remarkably consistent upward growth. No other asset class has matched this performance over extended periods. Not bonds, not real estate, not commodities, not any alternative investment that Wall Street has dreamed up. Some people worry that buying the S&P 500 means you are stuck with whatever companies happen to be in the index, including the mediocre ones. But this misunderstands how the index works. Companies that succeed grow their market capitalizations and take up more of the index. Companies that fail shrink and eventually get removed. The index is constantly evolving, automatically rotating toward winners and away from losers. You do not have to identify the next great company. You just have to own the index, and the winners will come to you. Think about how much the index has changed over just my career. When I started in banking, IBM and General Electric and Exxon were the dominant names. Today it is Apple and Microsoft and Google and Amazon. If you had tried to predict which companies would dominate 40 years from now, you would almost certainly have been wrong. But if you owned the index, You captured all of that transformation automatically without making any predictions at all. This automatic evolution is one of the most underappreciated features of index investing. You do not have to identify the next great company. You do not have to predict which industries will thrive. You do not have to time when to rotate from one sector to another. The index does all of that for you. Companies that succeed grow their weightings. Companies that fail shrink and eventually get removed. The index is a self-cleansing mechanism that constantly upgrades the quality of your holdings. I want to share something about the resilience of the American stock market that gives me confidence in this approach. Over the past century, the S&P 500 has survived 2 world wars, the Great Depression, multiple recessions, oil crises, banking crises, terrorist attacks, pandemics, and countless other challenges. Through all of it, the long-term trajectory has been upward. Not every year, not every decade, but over any 20 or 30-year period, American stocks have delivered positive returns. This resilience reflects something fundamental about American capitalism. Our legal system protects property rights and enforces contracts. Our capital markets are deep and transparent. Our regulatory framework, while imperfect, creates an environment where businesses can operate and innovate. Our culture rewards entrepreneurship and risk-taking. These institutional advantages have made America the dominant economic power for over a century, and I do not see that changing anytime soon. When you buy VO, you are not just buying 500 stocks. You are buying into this entire system. You are betting that American capitalism will continue to function and grow over the coming decades. Given everything I have observed over my career, I consider that bet to be about as safe as any bet in investing. The second ETF is VTI, the Vanguard Total Stock Market ETF. This fund is similar to VO but broader. Instead of just the 500 largest companies, Vermont owns essentially every publicly traded company in America. We are talking about nearly 4,000 stocks spanning large caps, mid caps, and small caps. The expense ratio is the same as VU at 0.03%. You are getting broader diversification at no additional cost. The returns over long periods are very similar because the large cap companies dominate both indexes. But VTI gives you exposure to smaller companies that have historically delivered slightly higher returns over very long time horizons. The academic research on small cap stocks is interesting. Smaller companies are riskier, they are more likely to fail, their stocks are more volatile, but the survivors tend to grow faster than mature giants. Over very long periods, this small cap premium has added perhaps 1 to 2% annually to returns compared to large caps only. That premium has not been consistent, and it has been mostly absent in recent years, but the diversification benefit of owning the entire market is real regardless. I generally tell people to pick either VU or VTI for their core American stock holding. Do not overthink the choice. Both are excellent. If you prefer the simplicity and name recognition of the S&P 500, choose VUO. If you want the broadest possible diversification across all American stocks, choose VTI. Either choice will serve you well over decades. What you should not do is own both VU and VTI thinking you are getting additional diversification. The 500 companies in VU are all included in VTI. Owning both just means you are overweighting large caps, which is fine if that is your intention, but it is not adding meaningful diversification. Keep it simple. Pick one. The third ETF is VXUS, the Vanguard Total International Stock ETF. This fund owns stocks from developed and emerging markets outside the United States. Companies in Europe, Japan, the United Kingdom, China, India, Brazil, Australia, and dozens of other countries. Over 8,000 stocks spanning most of the publicly traded companies in the world outside America. The expense ratio is 0.07%, slightly higher than the domestic funds, but still extraordinarily cheap compared to actively managed international funds. For every $100,000 invested, you pay $70 per year. This gives you exposure to global economic growth that purely domestic portfolios miss. Now, I need to be honest with you about something. International stocks have been frustrating to own for the past 15 years. American stocks have dramatically outperformed. If you had put all your money in the S&P 500 and ignored international markets entirely, you would have more money today than someone who diversified globally. This is simply a fact. But here's what I tell people when they point this out. Past performance does not predict future results. The same American dominance that has persisted for 15 years did not exist in the decade before that. From 2000 to 2009, international stocks significantly outperformed American stocks. Investors who were fully concentrated in America during that decade actually lost money after inflation, while international investors earned positive returns. No one knows which markets will outperform over the next decade or two. The valuation data suggests international stocks are cheaper than American stocks by most measures, which historically has predicted better future returns, but valuations can stay extreme for extended periods. The best answer is that we do not know what will happen, given this uncertainty. I believe a modest international diversification makes sense for most investors. Having 20 to 30% of your stock allocation in international markets provides a hedge against American underperformance without dramatically reducing expected returns. Think of it as insurance. You hope you do not need it. You hope American stocks keep outperforming, but if they do not, the international allocation cushions the impact. There is also a psychological benefit to international diversification that people underestimate. When your entire portfolio is tied to one country and that country's market struggles while others prosper, it is emotionally difficult to maintain discipline. You feel like you made a mistake. You are tempted to chase performance and shift your allocation at exactly the wrong time. Having some international exposure means you always have part of your portfolio performing reasonably well, which makes it easier to stick with your strategy through difficult periods. Let me now explain why I consider most other investment products to be trash compared to these three simple funds. Actively managed mutual funds are the most common alternative, and the evidence against them is overwhelming. Studies consistently show that over 15-year periods, more than 90% of actively managed large cap funds underperform the S&P 500 after fees, 90%. These are professional managers with teams of analysts with access to company management, with sophisticated research capabilities, and 90% of them cannot beat a simple index fund that anyone can buy. I have seen this data from multiple sources over many years, and the consistency is remarkable. It does not matter which time period you study. It does not matter which research firm conducts the analysis. The results are always the same. The vast majority of active managers fail to justify their fees, and the small minority who outperform in one period are no more likely to outperform in the next period than managers selected at random. This last point is crucial and often misunderstood. People think they can identify skilled managers by looking at past performance. They seek out funds that have beaten the market for 5 or 10 years, assuming those managers have genuine talent that will persist. But the data shows that past performance does not predict future results in fund management. The managers who outperformed last decade are no more likely to outperform next decade than average managers. Often, they actually underperform because the strategies that worked previously become crowded or stop working. The reasons for this underperformance are straightforward. First, the fees are too high. The average actively managed fund charges around 1% annually in management fees alone. When you add trading costs, administrative expenses, and other hidden costs, the total drag can exceed 2%. That is a massive headwind to overcome. A manager has to beat the market by more than 2% just to match index fund returns after fees. Second, active managers must make enough correct predictions to overcome their fee disadvantage. The market is highly efficient for large cap stocks. The easy opportunities have been arbitraged away. Thousands of analysts are studying the same companies, processing the same information, reaching similar conclusions. Consistently finding mispriced securities is extraordinarily difficult even for smart, well-resourced professionals. It requires being smarter than the collective wisdom of millions of market participants who are all trying to do the same thing. Third, and this is something people do not think about enough, size works against active managers. When a fund gets large, its trades move markets. It cannot buy and sell without affecting prices. The very success that attracts assets makes future success harder. A strategy that worked with $100 million may not work with $10 billion. The best small funds eventually become mediocre large funds as their strategies stop working at scale. Hedge funds are even worse for most investors. They charge 2% of assets plus 20% of profits. To justify those fees, they need to dramatically outperform simple benchmarks. Very few do consistently. The famous bet between Warren Buffett and the hedge fund industry proved this decisively. Over a 10-year period, a simple S&P 500 index fund beat a portfolio of elite hedge funds by nearly 90 percentage points. The hedge funds captured barely a quarter of the returns available to anyone who just bought the index. Target date funds are better than actively managed funds, but still more expensive than necessary. These funds charge 0.1 to 0.2% typically, compared to 0.03% for VU. That difference seems trivial, but compounds into meaningful money over decades. Target date funds are fine if you want complete simplicity and automatic rebalancing. But you can do better with a little effort by managing your own allocation across the 3 Vanguard ETFs. I have described thematic ETFs and sector funds have proliferated in recent years, and I consider most of them to be marketing vehicles rather than sound investments. Funds focused on artificial intelligence, clean energy, cannabis, blockchain, or whatever is trendy charge higher fees and encourage investors to chase performance. By the time a theme is popular enough to have dedicated funds, much of the easy money has already been made. Investors pile in at the peak of enthusiasm and suffer when reality disappoints. I have watched this pattern repeat throughout my career. Whatever is exciting right now attracts money. Products get created to capture that enthusiasm. Investors buy at the top, the theme disappoints or normalizes. Investors lose money and move on to the next exciting thing. The only consistent winners are the fund companies collecting fees throughout the cycle. Let me explain how I would actually implement a portfolio using these 3 Vanguard ETFs, because the details matter for younger investors with decades until retirement. I would suggest an aggressive allocation, perhaps 80% in VO or VTI and 20% in VXUs. At this stage, you can afford volatility because you have time to recover from downturns. You want maximum exposure to equity growth. Bonds and other conservative investments just drag on long-term returns when you have a multi-decade time horizon. For middle-aged investors approaching their peak earning years, I would shift to perhaps 70% domestic stocks, 20% international stocks, and 10% bonds. The Vanguard Total Bond Market ETF, ticker BND, is an excellent low-cost option for bond exposure. This allocation still emphasizes growth, but introduces some stability as you accumulate more wealth that you cannot afford to lose. For investors approaching or in retirement, I would suggest perhaps 50 to 60% in stocks split between domestic and international, with the remainder in bonds. At this stage, you need your portfolio to provide income and preserve capital. The stock allocation maintains growth to keep pace with inflation. The bond allocation provides stability and income for living expenses. These are starting points, not rigid prescriptions. Your specific allocation should reflect your personal circumstances, your risk tolerance, your other sources of income, and your financial goals. The key principles are to keep costs as low as possible, to diversify broadly, and to maintain an allocation you can stick with through market volatility. Set up automatic investments so you do not have to think about it. Have money transferred from your paycheck or checking account directly into your investment accounts every month. This dollar-cost averaging approach removes the temptation to time the market. You buy consistently regardless of whether prices are high or low, which smooths out your entry points over time. Reinvest all dividends automatically. The compounding effect of reinvested dividends is enormous over long periods. A substantial portion of total stock market returns historically have come from dividends reinvested to purchase additional shares. Do not let dividends sit in cash. Put them back to work immediately. Rebalance annually if needed, once a year. Check if your allocation has drifted significantly from your targets. If stocks have soared and now represent 80% of your portfolio when you wanted 70%, sell some stocks and buy bonds to get back to target. This imposes discipline and forces you to sell high and buy low. But do not rebalance more frequently than annually. More frequent rebalancing generates transaction costs and taxes without improving returns. Most importantly, ignore short-term market fluctuations. The daily movements of stock prices are noise. They tell you nothing about where prices will be in 10 or 20 years. Checking your portfolio constantly leads to anxiety and bad decisions. Check it quarterly at most. Annually is even better. Spend your energy on your career, your family, your health, the things that actually improve your life rather than obsessing over numbers that fluctuate randomly. Let me share something about market crashes, because this is where most investors destroy their returns. Markets crash periodically. It has happened throughout history and will continue happening. When crashes occur, the news is uniformly terrifying. Experts predict disaster. Your portfolio shows huge losses. Every instinct screams at you to sell, to stop the bleeding, to get out before things get worse. This instinct is exactly wrong. Crashes are buying opportunities, not selling opportunities. The investors who build the most wealth are the ones who maintain their composure during crashes and continue buying at temporarily depressed prices. The investors who destroy their wealth are the ones who panic, sell at the bottom, and miss the eventual recovery. I lived through the 2008 financial crisis from inside one of the largest banks in the world. I watched the panic spread. I saw legendary financial institutions fail. There were moments when the entire global financial system seemed to be collapsing. People were withdrawing cash from banks. Money market funds were breaking the buck. Credit markets were completely frozen. It felt like the end of the financial world as we knew it. And yet, if you had simply held your index funds through that crisis, you would have recovered all your losses within a few years and gone on to earn spectacular returns over the following decade. The S&P 500 fell over 50% from peak to trough. Then it recovered and went on to multiply many times over. The investors who sold at the bottom locked in devastating losses. The investors who held steady, or better yet bought more, were rewarded enormously. I remember the conversations I had with wealth management clients during that crisis. Many of them wanted to sell everything and go to cash. They were terrified. They could not sleep. They watched the value of their portfolios decline day after day, and they wanted the pain to stop. Some of them did sell, and those who sold near the bottom never recovered. They sat in cash, waiting for it to be safe to get back in, and by the time they felt comfortable, the market had already recovered most of its losses. The same pattern has repeated after every crash in market history. The 1987 crash, when the market fell over 20% in a single day, the dot-com bust. When technology stocks lost 80% of their value, the 2008 crisis, when it seemed like the banking system might collapse entirely. The COVID crash of 2020, when the market fell over 30% in a matter of weeks. Every single time, the market recovered and went on to new highs. Every single time, the investors who sold in panic locked in losses and missed the recovery. Every single time, the investors who held steady or bought more were rewarded. I cannot predict when the next crash will happen. No one can. But I can tell you with certainty that it will happen eventually. The question is not whether you will experience a crash. The question is how you will respond. If you can maintain discipline, if you can stick with your strategy, if you can view falling prices as opportunities rather than disasters, you will be fine. If you cannot, all the investment knowledge in the world will not help you. The psychological preparation for crashes is just as important as the financial preparation. Before a crash happens while markets are calm, you need to decide how you will respond. You need to commit to holding your investments regardless of how scary things get. You need to have a plan, and you need to stick to it, making decisions in the middle of a panic. When emotions are running high and information is conflicting, almost always leads to mistakes. Let me close with some perspective on what actually matters for building wealth over time. The financial industry wants you to believe that investing is complicated, that you need experts, that you need constant attention and adjustment. They want you to believe this because complexity justifies their fees. Every product they sell, every service they provide, every trade they execute generates revenue for them. If investing were simple, their business models would collapse. But investing is simple, not easy, but simple. The 3 Vanguard ETFs I have described today give you exposure to essentially every public company on the planet for fees so low they barely register. They require no expertise to own. They require no monitoring or active management. They just compound wealth year after year for patient owners. The hard part is not choosing the right funds. The hard part is maintaining discipline over decades, continuing to invest when markets are scary, ignoring the noise that encourages you to trade, resisting the temptation to chase performance or try something new, sticking with a boring strategy when everyone around you seems to be making money with exciting alternatives. The gap between what the average investor earns and what they could earn with a simple index fund approach is enormous. Studies suggest the average investor underperforms by 3 to 4 percentage points annually due to fees, taxes, bad timing, and emotional decisions. Over a 40-year investment career, that gap compounds into millions of dollars. You do not have to be average. You can choose differently. You can stop buying the trash that Wall Street sells. You can stop paying fees for underperformance. You can embrace simplicity and let compound interest work its magic over decades. VU or VTI for American stocks. VSUS for international stocks. Automatic contributions, reinvested dividends, annual rebalancing. Patience through volatility. Then the formula. It is not exciting. It will not impress anyone at parties, but it works. It has always worked, and it will continue working for everyone who has the discipline to stick with it. I have seen too many people reach retirement with far less than they should have because they made poor investment decisions along the way. They paid too much in fees. They traded too frequently. They panicked during downturns and sold at the worst possible times. They chased hot investments and bought at peaks. They trusted advisors who prioritized their own compensation over client outcomes. You do not have to repeat those mistakes. The information I have shared today is not secret. It is not complicated. It does not require special access or sophisticated analysis. Anyone can implement this strategy. The only barrier is the discipline to actually do it and stick with it through all market conditions. The financial industry will continue trying to sell you complexity. They will continue creating new products with impressive sounding strategies. They will continue running advertisements that promise superior returns. They will continue paying financial advisors to steer clients toward expensive funds that generate commissions. This will not change because it is how they make money, but you do not have to participate in their game. You can opt out. You can buy these 3 simple Vanguard ETFs, set up automatic contributions, and ignore everything else the industry tries to sell you. You can let compound interest work its magic over decades while paying almost nothing in fees. You can build wealth steadily and reliably without the anxiety that comes from trying to beat the market. That is the real secret to successful investing. Not finding the next hot stock, not timing the market perfectly, not accessing exclusive investments available only to the wealthy. Just buying broadly diversified low-cost funds, contributing regularly, and leaving your money alone for decades. Simple, but not easy, boring, but effective. Stop making investing complicated, start making it simple. Your future self will thank you.